Medical experts from three leading health institutions of the country, Indian Public Health Association, Indian Association of Preventive and Social Medicine, and Indian Association of Epidemiologists, have said in a report that it was high time to declare an end to the pandemic. On January 12, there were just 2,309 active COVID-19 cases in India. The movement of people is also nearing the pre-pandemic level, suggesting economic revival. According to a Business Standard report, the Indian Railways had recorded 76% year-on-year growth in its passenger revenue in the first 8 months of this financial year. The national transporter garnered Rs 43,324 crore from its passenger services until November against Rs 24,631 crore in the corresponding period last year. Unreserved tickets have garnered 422% more revenue between April to November as compared to the previous year. So it all suggests that railways are back on track. While experts said that the rise in revenue can also be attributed to the hike in fares, they all agreed that the footfall has certainly increased. In September 2022, the daily average ridership of Delhi Metro touched 87% of pre-pandemic level. The DMRC-operated metro has been running at 100% capacity since February. Meanwhile, the average daily ridership for local trains has crossed 40 lakhs on Central Railway and 30 lakhs on Western Railway, just about 5 lakhs short of the pre-pandemic level. Officials attributed this shortfall to hybrid work arrangement. Traffic has also increased in the sky. In fact, airports are brimming with people holding plastic trays and waiting for their turn. According to a CareEdge ratings report, air passenger traffic will hit 93% of pre-pandemic levels in FY23 and surpass pre-COVID levels in FY24. So what does this increased movement of people mean?
Along with the traveling, certain amount of spending automatically comes. Whether this will translate into higher consumption, that is still something not very much feasible and cannot be linked with the increased travel. For the simple reason that, the high inflation of last several months have actually eaten into the household's earning. I mean, in fact, their real income has been severely hit.
According to an RBI report, bank credit grew by 17.5% year-on-year to Rs 131 trillion in fortnight ended December 2. It suggested continuation of firm demand for loans in the economy. SBI expects corporate loans to grow at an average of 12% over the next 2 financial years. But will it sustain?
See, if you're looking at 22-23, we have seen definitely a rapid growth in bank credit. Now, to my mind, there will definitely be a slowdown in growth in credit. There are 2 reasons for it. One is that we all agree that there's going to be an economic slowdown in 23-24 on account of the global recession. We're all talking in terms of growth slowing down from 7% to something like 6 to 6.5%, which means that there will be less credit offtake. Second, we have seen that the RBI has been increasing the repo rate. And if monetary policy has to work anywhere in the world, it necessarily has to lead to a slowdown in growth and credit.
A poll conducted by Business Standard of 35 CEOs showed that Indian companies are planning to increase investment, acquire companies, and go on a hiring spree in the calendar year 2023. However, they also cited hindrances such as increasing interest rates, rising costs, and weak consumer demands. Inflation, which fell slightly towards the end of CY22, was also cited as a hindrance. Almost all the CEOs in the poll said they had high expectations from the upcoming budget. So will the investment cycle pick up?
So this is what is still worrying a lot of private corporate investment, that even while the recovery is on, they are still not confident whether this recovery is here to stay. They are certainly in a position to undertake the CapEx, but they are sitting on the fence. They are just waiting and watching how things pan out. The companies are not investing in new capacity. They are not coming with new factories. But at the same time, to say that they are not undertaking capex would also be wrong, because even to run the current factories, they have to undertake what is called maintenance capex. So that in any case is continuing.
Apart from consumer demand and private investment, there are other factors that will affect the economy. The Russia-Ukraine war, rise in crude prices, and global slowdown are playing a spoilsport. Global as well as domestic inflation was on the rise till a few weeks ago. Kristalina Georgieva, Managing Director of International Monetary Fund, has warned that a third of the global economy might face recession in 2023. She said the major factors behind a possible recession was slowed economic growth of the EU, China, and the USA simultaneously. So how will it affect the economy in the days to come?
Where we get affected is basically in terms of exports. So tomorrow, if we're talking of a recession which is going to take place in most of the Western countries or even an economic slowdown, there will be less demand for our exports. And that's where I see a kind of a definite shift in terms of the movement of growth in aggregate demand. Besides this, we'll also see the impact in terms of overall flow of funds, where there would be foreign investment in particular is something which needs to be seen as to how it works. Which FDI has already shown signs of a slowdown. There could be a further slowdown in 23-24. FPI will continue to be as whimsical as ever, but definitely there will be a fewer reservoir of easy funds available for investors to invest in emerging markets.
According to estimates of the National Statistical Office, the Indian economy may grow at 7% in FY23. This is higher than the RBI's estimate of 6.8%. Estimates from several agencies and the World Bank have put India's GDP growth at more than 6% in FY24. This comes around the time when the IMF has pegged global GDP growth at a mere 2.7%. Ratings agency S&P Global has forecasted a contraction of 0.1% in US GDP in FY23 and 0% growth in EU. While passenger numbers across railways and airlines have increased amid the reduced threat of COVID-19 and in the absence of renewed restrictions, there may not necessarily be a corresponding increase in consumer demand. Household incomes were impacted last year as inflation remained above RBI's upper tolerance band for most of it, and sticky core inflation remains a worry. As such, India Inc. could continue to sit on the fence as far as making significant fresh investments is concerned.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.